Welcome to Middleway News. We provide the latest news highlights and summaries each day to give you a quick snapshot of what's happening today and why.
Here is a summary of Chapter 8 of Benjamin Graham's The Intelligent Investor, which is Warren Buffett's favorite books, and this chapter is his favorite. The main lesson of Chapter 8 is the importance of rationality and independence in investing. Investors should focus on the intrinsic value of stocks and make decisions based on thorough analysis rather than market sentiment, taking advantage of Mr. Market's irrational behavior for profitable opportunities. Let's dive into the wisdom by starting with an understanding of Mr. Market, simplifying Mr. Market, and applying the wisdom step by step from The Intelligent Investor, understanding Mr. Market. 1. The analogy, Mr. Market, imaginary character representing the stock market, behavior, bipolar, sometimes very optimistic, sometimes very pessimistic. Daily offers, Mr. Market offers to buy or sell shares at a certain price every day. Key lesson, use your own rational judgment about the value of your investments rather than being influenced by Mr. Market's daily offers. Applying the wisdom step-by-step key point, #1. Know what you own. Step 1. Research the business. Action. Before buying a stock, understand the business. Read annual reports, analyze financial statements, and understand the company's products, market position, and competitive advantages. Example, if you own shares in Apple, understand its business model, product line, market share, and financial health. Step 2. Determine intrinsic value. Action. Calculate the intrinsic value of the stock. Use methods like discounted cash flow, DCF analysis, comparing price to earnings, PE ratios, and other financial metrics. Example, if Apple's intrinsic value is calculated to be $200 per share, this will be your benchmark. Key point #2, ignore market volatility. Step 3, avoid emotional reactions. Action, ignore short-term price fluctuations. Focus on the long-term fundamentals of the business. Example, if Apple's stock drops to $180 due to market panic, but its fundamentals are strong, avoid selling out of fear. Step 4. Review regularly. Action. Periodically review your investments based on their financial performance and industry conditions, not on market price movements. Example. Check Apple's quarterly earnings and annual financial reports to ensure it remains a sound investment. Key point #3. Capitalize on opportunities. Step 5. Buy low. Action. Take advantage of Mr. Market's pessimism by buying stocks when their prices fall below their intrinsic value. Example, if Apple's stock falls to $150 while its intrinsic value is $200, consider buying more shares. Step 6. Sell high. Action. Consider selling when Mr. Market is overly optimistic and prices soar above intrinsic value. Example, if Apple's stock rises to $250 but its intrinsic value remains $200, consider selling to realize gains. Key point #4. Stay rational and disciplined. Step 7. Use checklists and reminders. Action. Use a checklist to review investment decisions and keep rational guidelines in mind. Example. Keep a note saying, never buy a stock immediately after a substantial rise or sell one immediately after a substantial drop in your workspace. Step 8. Learn continuously. Action. Keep learning about investing. Read books like The Intelligent Investor and Influence by Robert Cialdini. Example, implement strategies from these books to enhance your investment decisions. Summary, rational decision-making, base decisions on intrinsic value, not market fluctuations. Long-term focus, concentrate on the business's fundamentals over time. Emotional control, resist fear and greed driven by market volatility. Learning and adapting. Continuously improve your investment knowledge and strategies. By following these steps, you can use Mr. Market's bipolar nature to your advantage, making informed and rational investment decisions. Here is a quick summary of hot topics from Chapter 8 of Benjamin Graham's The Intelligent Investor. Chapter 8 of Benjamin Graham's The Intelligent Investor focuses on Mr. Market and how it relates to stock market investing. It aims to explore key investing concepts and strategies mentioned in the chapter. Mr. Market explained. Mr. Market is a metaphor used by Benjamin Graham to describe the stock market's behavior. He is an imaginary investor who offers to buy or sell shares every day. His moods fluctuate between optimism and pessimism, affecting stock prices. Investors are encouraged to take advantage of Mr. Market's irrationality rather than being influenced by it. The lesson of Mr. Market. The main lesson is to remain rational and unemotional about stock prices. Investors should view Mr. Market as a guide to potential opportunities rather than a source of advice. They should buy when prices are low and sell when prices are high, independent of Mr. Market's erratic behavior. How to avoid stock market pitfalls. To avoid pitfalls, investors should focus on the intrinsic value of stocks rather than their market price. Patience and discipline are key, as well as conducting thorough research and understanding the fundamentals of the companies they invest in. Peter Lynch, on knowing what you own. Peter Lynch emphasizes the importance of knowing and understanding the companies in which you invest. He suggests that investors should be familiar with a company's operations, financial health, and growth prospects to make informed investment decisions. How to benefit from Mr. Market. Investors can benefit from Mr. Market by being contrarian, buying undervalued stocks when the market is pessimistic, and selling overvalued stocks when the market is overly optimistic. This strategy relies on understanding the intrinsic value and remaining patient. The efficient market hypothesis. Theory, the efficient market hypothesis, EMH, suggests that stock prices reflect all available information and that it is impossible to consistently outperform the market. According to EMH, stocks always trade at their fair value, making it difficult for investors to buy undervalued stocks or sell overvalued ones. Proof the efficient market hypothesis is false. Chapter 8 of Benjamin Graham's The Intelligent Investor presents arguments against EMH, highlighting that market inefficiencies exist and that it is possible to outperform the market by identifying undervalued stocks. Examples include successful investors like Warren Buffett, who have consistently achieved higher than average returns. Net example for a public company. What is a net example for a public company? This involves identifying companies trading for less than their net current asset value, current assets minus total liabilities. Such companies are considered undervalued and provide potential investment opportunities. Net example for a private company. The concept of net is also applied to private companies. Investors can look for private businesses with a strong balance sheet, where the company's net current asset value exceeds its market price, indicating potential for significant returns. How Buffett invested in nets in his early years. Warren Buffett's early investment strategy involved buying nets. He looked for companies trading at a discount to their net current asset value, providing a margin of safety and potential for high returns when the market recognized their true value. Warren Buffett on cigar butt stocks. Cigar butt stocks are those with a few puffs left, meaning they are deeply undervalued but may not have long-term potential. Buffett describes this strategy as buying cheap stocks that can provide short-term gains, though he later shifted to investing in quality companies with sustainable growth. Nets and value investing today. Chapter 8 of Benjamin Graham's The Intelligent Investor discusses the relevance of nets and value investing in the current market. While the opportunities for nets have diminished, the principles of value investing, focusing on intrinsic value and a margin of safety, remain applicable. The main lesson of Chapter 8. In closing, we repeat that the main lesson of Chapter 8 is the importance of rationality and independence in investing. Investors should focus on the intrinsic value of stocks and make decisions based on thorough analysis rather than market sentiment, taking advantage of Mr. Market's irrational behavior for profitable opportunities.
Thank you for watching the Middleway News Daily Update.
Thank you for experiencing today's Middleway News Daily Update. We hope you enjoyed today's top news highlights and summaries. Be sure to check out our other Middleway News services, products, summaries, updates, videos, podcasts, and more.